Here's an example of somehow how bond price quotes are given. If you look, let's see, right in here, you can see the prices, and it's like 104, 100, 96.5, 94.75. It's all a percentage of par value. I'm going to skip this slide. So here's how you calculate the actual price of a bond when you buy it. It's going to be, and this invoice price is basically the definition of what you ultimately pay. And the way to calculate that is to combine the quoted price, which is the price you see, like what we just saw on the slide ago, plus this accrued interest. And again, the accrued interest basically has you pay the seller for the amount of coupon that is accrued from the previous coupon payment to when you bought the bond. Okay, and it's basically the annual coupon divided by 2, which is just the coupon every 6 months, right? So the amount of the coupon payment multiplied by the number of days since the last coupon payment and divided by the total number of days since the last coupon payment. So it's kind of like prorated, basically, right? Let's do an example here. So let's assume the Treasury bond has an 8% coupon rate, 30 days have passed since the last coupon payment, 30 days, and the quoted price is $9.90. What would the invoice price be? So a couple things. First off, we know the invoice price is going to be the quote price, right? Plus the accrued interest, right? And quote price, that one's pretty easy. That's given. $9.90, right? And I also could have told you that the quote price, instead of in dollars, I could have told you just 99. And then you would have to be able to translate that to dollars. So 99 is 99% of $1,000. 99% of 1,000 is $9.90. And then for the accrued interest, it's going to be that annual coupon divided by 2. What's the annual coupon? 8% of face value, right? Assume 1,000 for all of them, right? And then we divide that by 2. But then we multiply that whole thing times the ratio of the number of days since the last coupon payment divided by the total number of days between coupon payments. Now here, the market gets a little fussy about the definition of the number of days between coupon payments. You think it would just be half a year, right? You would guess 182.5. Well, you know, bond markets are pretty old, right? More than 100 years, easy. And they didn't have calculators. Maybe they had abacuses, or however you say it, right? And so they kind of settled upon standard numbers to use. And it kind of varies. And so bear with me for a second here. I think I might have put some notes down here. Yeah. So check this out. The number of days between coupon payments, right? They assume usually 182 days, okay? And that's for treasuries, which is the biggest market, okay? I know 182.5, but they just use 182. For corporate bonds and money market instruments, the assumption is 360 days in a year, in which case it's 180 days between coupon payments. So treasuries, 182, everything else, 180. That's the number of days. You can see that down in the notes there. So we're going to do 182 because it's a treasury. And then you go ahead and calculate that. And what do you get? I think the solution is down here, actually. It looks like 996.59. Okay. All right, so this complicated looking formula you've actually seen and used already. All it is just a kind of a fancier way of writing the formula for the present value of all future bond cash flows. And the present value of all the cash flows is just what we think like the price of the bond should be, or the value of the bond. The actual price, can vary in the marketplace based on supply and demand, right? So this is just our estimate of, if you will, the intrinsic value of a bond. Right, C is the coupon payment right here, and we divide it by 1 plus the discount rate, right? And this little sideways M is Greek letter sigma, capital S, which is used for summation. So it means we're summing up the present value of all the coupon payments. That's all it basically means. It's just a shorthand way of writing it. And then we take the par value, face value, $1,000, and we take the present value of that as well, right? A couple things here. If you recall, because coupons are paid twice a year, to calculate that coupon payment, you take par value times the coupon rate divided by 2. We just did that, right? To calculate the number of periods in the bond, you take the number of years and multiply by 2, because remember, from present value, time value of money, the time period always has to align with when the cash flows come. And the cash flows on a bond come every 6 months, so a period has to be 6 months. All right? And so you take the number of years, you multiply it by 2, and that gives you the number of 6-month periods, basically. The discount rate, which is in the denominator, that's the R, right? That's called the yield to maturity on a bond. And that interest rate has to align with the 6-month period. But yield to maturity is always communicated on an annual basis. So we have to do a little conversion when we do this calculation. And that conversion is just taking the yield to maturity and dividing by 2. So we have to do a couple adjustments on this, and but once you get the hang of it, it's not too bad. So here's an example: the $1,000 par value bond, 10 years to maturity. You got a coupon of 8% and the yield to maturity of 6%. We're gonna look at a couple different ways to solve this problem, depending on the experience you had in Finance 300. I'm not going to go over this one in detail, but if you want to use a financial calculator, you can. The main reason to learn the financial calculator is if you plan on taking, some kind of certification exam, either in accounting or finance. The other way to do it is to use Excel. And Excel has 2 ways of doing it. The way I have pictured here uses a specific formula called price. And you can access that formula in Excel by going into a cell and typing in equals price, and then you put in all these parameters. You can see the formula right here. Right? And these are the parameters: the settlement date, the maturity date. So this is a little more detailed. It's down by the day. Okay? It's not like your normal present value formula. Then the annual coupon rate, the annual yield to maturity, and the formula takes care of those adjustments. The redemption value always put in 100% for that. Okay? That's like if you're assuming that in some special situation where you're not going to get all your money back, that type of thing. And then you put in the number of payments per year, and it gives you a price. It gives you a price in terms of the percentage of par value, right? So you see here 114.877. You have to multiply that by 100%, right? And that gives you 1,114.877. Let me show you a way to use the time value of money stuff that you're used to from Finance 300 in Excel. And this is the way I think you should do it, during exams and stuff like that. Bear with me for a second. Hopefully you can see that. All right, so I think the easiest way to probably do this is probably because it's going to use the same stuff you learned in Finance 300. I would suggest using the present value formula in Excel. Okay, and you can see here the formula requires a couple pieces of information: the rate, NPER, which stands for number of periods, PMT, which stands for payment, and then it has a FV, which stands for future value, and it's in brackets because it's optional, but we're always going to put in future value. And then type, just leave type blank, and it reverts to the default, which assumes that all cash flows happen at the end of our periods, which is what we always do in finance. All right. So the first thing, the rate, is basically going to be the yield to maturity divided by 2, right? We're given a yield to maturity there of 6%, right? So I'm going to take that 6% and divide it by 2. 3%. 6% divided by 2, okay? And the next is the number of periods, or N per, and it's a 10-year bond. We multiply it by 2 to get 26-month periods. So I'm going to do 10 times 2, okay? And then the PMT, the payment, and the payment will be 8% multiplied by face value of the bond, right? And then divide by 2, okay? And then future value. Now the bond's going to be paid back the full face value, $1,000 at the end, and leave it at that, and we should be good. And I got 1148.77. Now, if I asked you what the price of this bond should be, you wouldn't say negative 1148.77, because the way the time value of money functions work in Excel is it always keeps direction. It keeps track of the direction of the cash flow. But if I ask you what the price is, you just tell me what the price is, right? I'm not asking you what's the value of the cash flow if you buy it. If I did that, then you could say, well, the cash flow for you from the perspective of the investor is a negative cash flow if they buy it, negative cash flow 1148. But that's not how we talk, but that's how Excel works behind the scenes with time value of money functions. It's always keeping track, right? And it assumes, since we put positive cash flows in the future, we're getting positive cash flows in the future. To make the math work, we have to be giving up money today to get those cash flows in the future. That's why it's a negative cash flow. All right, then we have yield to maturity. And in the yield to maturity, all we're basically doing now is instead of calculating the price, which we just did, now we're going to be given the price, and we're going to be asked to calculate the R in here, which is the yield to maturity. And you pretty much have to use a calculator to do this, because if you look back at this problem here, right, you could go through the math by hand or with a calculator, and you could do all this right here and calculate b. But look at this problem. You've got 1 plus r to the t, and there are all these values of different denominators of 1 plus r to different t's, and there's no way there's no closed form solution, as we say. You can't just calculate it. What you would have to do is you have to guess a value for r and plug it into all these different terms and see if it the right-hand side of this equation balances to the left. You're not doing that. You need a calculator to guess a value, and it just does an iterative approach to try and balance the two sides of this equation. So that's why, you had to use a financial calculator, right, to calculate the yield to maturity on a bond before. You couldn't just do math on it. And so we're gonna use Excel again, but I'll show you how you can do that here. So this is the same bond we had before, but now we're assuming a given price of $1148.77, and then we have to calculate the yield to maturity. So here's all the data you would put in if you're using the financial calculator, and here's if you use the yield function in Excel. Right, if you were working for a stock brokerage or wealth management, and you had a client, they had a specific bond they wanted to sell, if you wanted to estimate it, you're probably better off using this formula than the time value of money ones we're going to do, because this takes it down to the day, right? And when we do the math for some of these bond problems, we're always assuming, kind of in a way, that the next bond is going to come in 6 months, the next cash flow, right? You thought about that? You know what I mean? And that's why one of the deals with using the math formula, when we calculate accrued price, that takes into account the cash flow coming in, splitting up the coupon and stuff like that. But this, I think, is the way to go if your life counted on giving an accurate price. But let's take a look at this. Here, this problem. All right, so this was the bond price. Now let's calculate the yield. And so we had the PV function we used for the price. For this one, it's going to be the rate function. Okay, and this is just like if you remember, on your calculator, if you use that. This is for those time value of money functions from Finance 300. So the first thing to do if we're calculating the R, or the rate, is the number of periods. And we did that already, and that was 20 periods, right? And we already did the PMT, right? That was 8% of 1,000 divided by 2. So I'm just going to put in that cash flow. I think that's $40. And then the present value. The present value is the price. Now here, because of the way Excel works with, balancing cash flows and assuming, you're getting money back and then you pay money out, and how it gave us that negative answer before, we have to be specific about the direction of the cash flow when we're calculating the rate, because we're mixing present value and future cash flows in the same problem, right? Because we're telling it that the present value right now today is minus 1148, and I'm using that negative because it knows that way we're paying money out. And then I'm also telling it that the future payment, the money we're getting back, is positive, because it's going to be balancing these cash flows. If we put in positive for everything, we're going to get an error. I'll show you that in a minute. And then the future value we're getting, that's a positive number, right? So we're paying out 1148. And then we're getting back $40 per period plus 1,000 at the end, right? And then end parenthesis, and that should be the rate. I suggest you do this on your calculators. You increase the number of significant digits on these problems. Excel will automatically default to 2 decimal points, which is 1%, right? And a basis point is 0.01%. So you won't see basis point differences in answers if you don't increase the number of digits like I just did. So you just go to here to number, and then I hit this thing right here, and it increases the number of digits it shows to the right of the decimal point. Okay, so that's 3%. But time value money, we assume 6-month period. So if the question is, what is the yield to maturity, i.e. annual yield to maturity, because that's how we normally display it, you're going to have to take that number and multiply it by 2. Okay? And so the answer is actually 6% yield to maturity. Okay, notice it right here, how it shows 6%. And actually in this formula, golly, I should restate that as multiplied by 2. Okay, but the answer is 6%. This is the periodic yield, if you will. All right, I'm going to stop it there because my video software has been crashing, and so I don't want to make too long of a video. So this will be part B, end of part B, and then I will still have to do probably part C, maybe D. Thanks.